This is Financial Literacy 101, where I will explain the core principles that govern how money actually works. My name is Detutu, and I am a finance professional living in Germany. The first principle is income versus net worth. This is the concept that most people get wrong. Before we talk about taxes or investing, we should clear up the most common misconception in personal finance, which is confusing income with wealth. Let's meet two hypothetical people, Ade and Olu. Ade is a senior executive earning 150,000 euros a year. From the outside, he looks wealthy. He has a car, a luxury car, a large rented apartment, even a designer wardrobe. But Ade spends exactly what he earns. He has zero savings and also has 20,000 euros sitting on a high interest credit card. His net worth is negative 20,000 euros. Ade is not wealthy. He's a high income earner living paycheck to paycheck. Olu, on the other hand, is a mid-level manager on 65,000 euros per annum. She drives a used car she bought outright and she rents modestly. Every month, Olu invests 1,000 euros into a global index fund. 10 years later, her portfolio sits at approximately 180,000 euros. Zero debt, net worth 180,000 euros and growing. If Ade were to lose his job on a Friday, he's in crisis by the end of the month. If Olu, on the other hand, loses hers, she can sustain herself for years. Income is what you earn. Wealth is what you keep. And it starts with knowing exactly what you take home, which brings me to the next point, the difference between gross income versus net income. Your gross income is a number on your contract. Your net income is what actually hits your bank account after deductions. Deductions like income tax, social security, pension contribution, health insurance, unemployment benefits, and so on. The gap is significant. In Germany, for example, on a 55,000 euro gross salary, you're taking home around 2,950 euros a month after all deductions. That's nearly 1,600 less per month. Every financial decision you make, your rent, your savings target, your investment contributions, anything should be based on your net income, not the number on your contract, but rather the number that lands in your account. Now let's talk about debt. A lot of people don't like talking about debt, but we're going to talk about it today. There are two types of debt, okay? Debt is not inherently bad, but understanding it can set you back by years. And like I said, there are two types of debt. There's the constructive debt and the destructive debt. Destructive debt is borrowing to buy something that immediately loses value. Credit card is a good example. Personal loans for holiday or car financing. A 10,000 euro credit card balance at 18% interest on minimum payments can take over 20 years to clear and cost you 2 to 3 times the original amount. Constructive debt, on the other hand, is borrowing to acquire something that produces value. A great example is a mortgage on a property that appreciates or a low interest loan to start a profitable business. The test is very simple. Will this make you more money than the interest you're paying? That's the question you should be asking. If you're currently in debt, you should try to eliminate high interest debt aggressively before you even consider investing. There is no consistent, risk-free investment that reliably returns more than 20% credit card interest. Every euro you are paying 20% on is costing you more than you can earn elsewhere. The next point is what changes everything for most people who invest, which is compound interest. Compound interest means you earn interest on your interest. If you invest 10,000 euros at a 7% average annual return, after 10 years, you earn just under 20,000. After 20 years, you get about 38,000 euros. After 30 years, you get 76,000 euros. And after 40 years, you have nearly 150,000 euros. Without adding anything, you just left it there. Time is doing most of the work. But compound interest works exactly the same way against you in debt, which is what makes high interest consumer debt so destructive. It is important to know which side of compound interest you're on. The next important point is inflation. Most people think their money is safer sitting in cash. I'm sorry to break it to you, but the opposite is the case. Central banks continuously expand money supply, and as more money circulates, the purchasing power of each unit falls. This is why a cup of coffee that cost you 2 euros or 3 euros 5 years ago costs you about 5 euros today. If you have 50,000 euros sitting in your current account, the number on the screen stays exactly the same. But what it can buy is shrinking at 3 to 5% a year. In a decade, your saved cash will buy roughly half of what it does today. This is why investing is not optional. It's the only mathematical defense that you have against guaranteed inflation. Keeping money in cash is not you being cautious. It's you losing your money slowly. How you keep your money in cash is also important, which is now my next point, the emergency fund. Before you invest a single euro, saving 3 to 6 months of essential expenses in a separate accessible savings account is your financial foundation. Without it, one unexpected event, a job loss, a car breakdown, a medical bill, forces you into expensive debt. With an emergency fund, you absorb the shock without derailing anything else. Your next question is probably, where should you keep your emergency fund? A high interest, easy access account. In Germany, it's called the Tagesgeldkonten, and banks like DKB, ING, or N26 have reasonable offers. You can set up an automatic transfer on payday, and once it's built, it stays there. It should be rebuilt every single time you use it. Now, the major point, investing. Investing is not really what you see on social media. It's not day trading crypto or chasing meme stocks. Really investing is the slow, systematic acquisition of productive assets. When you buy a share in a global index fund, you're buying a fractional piece of thousands of world's largest companies. Think Apple, Amazon, Nestle, Toyota. When those companies generate profits, that's reflected in your investments. You're detaching your ability to build wealth from your physical hours worked. Your money is working for you 24 hours a day, 7 days a week, 365 days a year without needing a break. The evidence against active fund management is mathematical. Over 15-year periods, the overwhelming majority of active managers underperform the index they are trying to build. The main reason is fees. Active funds typically charge 1 to 2% a year. Index funds charge 0.05 to 0.2%. How do you start? You can open a depot with Trade Republic or Scalable Capital. Invest in a broad global ETF like MSCI World. Set up a monthly direct debit. Invest consistently. Don't try to time the market. When markets fall, and they always will, don't panic. They have always recovered. Now let's talk about credit scores. Your credit score determines whether you can rent a flat, get a phone contract, or access a loan. The basics are the same everywhere. You pay every bill on time, don't apply for multiple credit products at once, and check your score regularly. In Germany, your SCHUFA score governs most of this. Check your free annual SCHUFA report at www.meinschufa.de. You're entitled to one every year. I have a designated video on SCHUFA on my channel that you can check out. I'll leave it in the description box below. And finally, financial literacy is not difficult, but it has consequences. The difference between understanding compound interest at 25 versus 35 is potentially hundreds of thousands of euros over a lifetime. The difference between building a 180,000 euro portfolio like Olu versus spending everything that you earn like Ade is not income, it's knowledge and the habits that follow from it. If you found this video helpful, please leave a thumbs up and drop a comment. Also, let me know which concept was newest to you. That tells me exactly what to cover next. Thank you so much for watching. I'll see you in my next video. Ciao.